I'll now invite Prashant Jain, CIO and Executive Director of HDFC Mutual Fund. Perhaps all of you know that Prashant has held only one job for the last 23 years. He's continued in the same job. Okay? He definitely has the best long-term track record of investing in the country. But perhaps if you were to do a study globally of fund managers with a track record of 20 to 25 years, I'm very sure Prashant would be a very serious contender for the first ranking globally. So I'm happy to invite Prashant. Prashant.
Good morning, friends, and thank you very much for coming from all parts of the country. Prem was very generous. Thanks, Prem, for those nice comments. And he also warned me before this talk that everyone is bored of HDFC mutual funds advice and presentations, which ask you to invest at low PEs. So he said, don't come and give that gyan again. So it must be something different. So when I thought about that, I realized that I am too old to now serve you something different because I don't believe in it. So I have went back to my MBA days. So I am going to serve you old wine in new bottle. And I hope the bottle is interesting and you enjoy the wine. So let us turn the whole debate upside down. We have always been saying practice low PE investing in equities, and that is all that you need to do. But let us ask a different question as to why don't people practice low PE investing? I mean, there must be something wrong, something right. Why do people invest time and again at high PEs? So, and that's what is the basis for this presentation, why investing right is so difficult. We firmly believe, and you can go back and see data anywhere in the world, that low PE investments, simply low PE investments over long periods do exceedingly well. But then why don't people get this simple message? And why do they find low PE investing so difficult? To get some thoughts into this, what I did is I went back over my career. I started working in 1991. And I put together a list of what have been the most popular investment decisions. Popular, I mean, which millions of people have decided to do at a particular point of time. And this is what I have compiled for you. In 1992, equities were the most popular asset class. And believe me, there were no foreign banks, there was no relationship managers, even the distribution business was very, very disorganized. And one scheme of a very popular mutual fund collected almost 5,000 crores in one single scheme. And this money at today's value is worth 20,000 crores. And today the largest scheme in the country is only 10,000 crores with lakhs of IFAs, partners, friends, relationship managers, foreign banks selling. Then in year 99 and 2000, technology stocks were the most popular. And technology funds collected a lot of money, and almost everyone in the country, whosoever had invested anything in the stock markets, bought shares like Infosys, Silverline, Pentamedia, DSQ, Rolta, Wipro, Satyam, everything, only IT and telecom. And then in 2003, people decided not to invest in equities. So that was again a decision. That what in 99, 2000 you invested 10,000 crores in mutual fund schemes only. In the year 2003, entire country put together, all of us put together, all 20, 30 mutual funds, so many partners, friends, all of us in one full year collected only 118 crores. So that was a clear vote that we have nothing to do with equities. Then came year 2007, and almost everyone or whosoever invested in equities bought either infrastructure funds or infrastructure stocks. And the industry, that was the record year for the industry so far. The industry collected 50,000 crores, and you can see there, 53,000 crores. And then we went back to our old love, and we, in the years 10, 11, 12, 13, for 3-4 years, our love story with gold became extremely strong. And you can see that the net gold imports in India in those 4 years went up almost 3 to 4 times. And I have given you the dollar prices of gold also below that. So gold we have always loved for centuries, but something happened and this love became very strong in those 2, 3, 4 years. So we must look at that. And finally today, what is the most popular investment decision? That sell whatever equities we have. So in the last 2 years, mutual funds in India have received record redemptions. And since April 12 till date, the industry has lost 24,000 crores. This is a record of sorts. So I am sure you will agree that there would have been few other decisions. I am keeping income funds out of this because in income funds, a lot of corporate money is there, and it becomes hard to conclude whether it was indeed the case or not. But these were the 6 most popular decisions to invest or to avoid in my experience. And let us now see as to how do people decide and what is common to these. So what I have realized is that each one of these decisions yielded you extremely poor returns. They were very wrong decisions. Or where you avoided, you missed out on great returns. So whatever you bought did not give you great returns, and whatever you did not buy, whatever you avoided, performed exceedingly well in the future. So that was one common thing to all these 6 popular decisions over last 20 years. The second common thing is that all the buying decisions, whether you bought equities in 1992, whether you bought technology stocks in 1999, whether you bought infra stocks in 2007, whether you bought gold in years 11, 12, 13, each one of these positive decisions, positive votes, were after great returns in the previous 3-4 years. And if you see the green rows, they pertain to the positive decisions. So we have given you the returns of some indicators of these asset categories. So if you look in 1992, as on March 92, the previous 3 years, what were the returns of the Sensex? 976%, which means the Sensex had gone up almost 10 times. So in 1988, believe it or not, the Sensex was at 400. And in 1992, it was 4,000. So the Sensex went up 10 times in 4 years. And Sensex was extremely expensive because it grew much more than the economic growth rates. The P's were a record high of 45 times in 1992. That was the only year in the history of Indian capital markets where P's have gone up above 30 times. So P's in 1992 were 45 times, and we invested record monies in equity funds. In the year 2000, if you look at the IT index, which was the most popular investments, the returns were an astounding 6,000%. So what this means is the IT index, and I went back and double checked this data yesterday. So the IT index in March 2000, between March 97 to March 2000, it had gone up 60 times, 60 times. You can go back and check this data. It is extremely difficult to believe just like that. So please go back and check the data. Then came the third positive decision was investing in infrastructure stocks and mutual funds. And in the year 2000, in the previous 3 years, this index had gone up by 200%. So it had become almost 3 times. And finally, if you look at gold, if you do MCX gold rupee prices, in March 12, the previous 3 years, gold was up 80%. So I think each one of the decisions where we decided to buy something was after that asset category had delivered great, phenomenal, above average, excessive returns in the previous few years. If you look at the negative decisions where we decided not to invest, and these are both instances when equities were out of favor. In 2003, in the previous 3 years, the Sensex was down 40%. In fact, Sensex had not performed for 10 years. In 1992, Sensex was 4,000. In 2003, it was 3,500. So when we used to go and do road shows, people would ask, why should I ever buy equities? For last 10 years, they have not given any returns. And we would turn around and tell them, because they have not given returns for 10 years, they should now catch up with the economic growth, and that's why you should invest in equities. So anyway, when we invested extremely low amounts in equities, the past performance of equities was extremely poor. If you look at today, the last 3-5 year returns, as Anup referred to, have been extremely disappointing for equities. Sensex was at 20,000 in Jan 2008. Today again we are there. Last 6 years returns are close to zero. Last 3 year returns are also 7%. So again we are seeing record redemptions in equity funds. So if you put all this together, I think what is happening is something very simple, that people are taking a very simple view of investments. They are saying whatever has done well in the past, let me get on to that. It will keep on happening. And whatever has not performed in the past, let me start avoiding it because it is no good. It has not delivered any great returns in the past. But investments is just the opposite. If you want to invest the right way, something which is there is a fair value to almost everything in life. Whether it is gold, real estate, equities, bonds, there is a fair value for everything in life. So the point is very simple. We need to do exactly the opposite of what we have been doing. Whatever has gone up, whatever has delivered great returns in the past, let us not assume that the same thing will continue. Let us stop extrapolating. Let us look what is the fair value of this. Chances are that whenever the past returns are great, the future returns are likely to be much less. Coming to equities specifically, it is a very simple asset class. In rupee terms, the nominal GDP in India is growing at 15% per annum. Even in the current year of slowdown, the real growth is 5%, but inflation is high, 9%. So you add the two together, you will still get a growth of 14-15%. So India is a high growth economy, it is a secular growth economy, it goes through its ups and downs, some slowdowns. But Anup showed you that slide which showed you how Sensex earnings have been growing at a fairly decent pace. In years of slowdown, they will grow a little less, but they will ultimately catch up. So India is an economy which for last many decades has been broadly growing between 13 to 16% in rupee terms. Whenever the Sensex gives you past returns which are much higher than this, it indicates that Sensex has done better than the economy and it is likely to be overvalued. And whenever you go back and see the previous 5-10 years, the Sensex has not done well, it has not delivered returns, or it has delivered lesser returns than the economic growth, the future returns should be much better. So the Sensex and economy are like two wheels of a car. They must keep together over long times, but once in a while one of the wheel goes ahead, then it must slow down, wait for the wheel which has gone behind to catch up, and vice versa. So I would simply urge you that this is extremely hard to do. I mean, there is nothing new what I am saying here. Whenever the past returns are very high, P's go up, and whenever past returns are low, the P's come down. That is why we have always been saying that invest in Indian equities at low P's, always. In fact, we have done some slides, we have sent this across to all of you, that whenever the P multiples are below 15 times in India, the next 3 and 5 year returns have been extremely encouraging. So whenever in the past, you can go back and do this simple exercise, whenever Indian Sensex was trading below 15 times 1 year forward earnings, if you bought the Sensex then, the next 3 and 5 year returns have been extremely encouraging, extremely popular. And this is what I would urge you to do it once again, that we must change the way we are investing. I think this is at the heart, this is the key issue which we find why investors are so dissatisfied with equities. If you don't invest at 400 Sensex in 1988, but invest large amounts in 1992, when Sensex is up 10 times, you don't make money for next 10 years. We did not buy IT in 1997 or 1995. When it went up 60 times, we bought large amounts of IT stocks. We did the same with the infrastructure stocks, and we have done the same with gold also. We are not experts on gold, but we think broadly that the interest rates in the world are going to rise. This tapering as it comes down, what does it mean? It means that US will stop printing more dollars, and US interest rates, everyone expects them to go up. People differ, how much will they go up, when will they go up? But broadly everyone agrees that interest rates in US go up. If interest rates go up, then gold should not do well. Gold did so well after 2008, after Lehman crisis, because to fight the economic slowdown, to fight the crisis, interest rates in US and many other geographies were nearly zero. If bank deposits are giving you zero returns, people will move some money into gold. That is why gold went up so high. So we think the outlook for gold is not very positive, but Indians unfortunately have bought record amounts of gold in last 4 years. It is so surprising. If you look at the current dollar prices of gold and current rupee prices of gold, there is a very big gap in that. 10% is because of customs duty and 10% is because of physical premium of gold. So this is a short-term measure to fight the current account deficit. Government has imposed some import restrictions and custom duty is so high. But clearly this is not sustainable. Even our finance minister has commented that they will review this structure in the next financial year, which is few months from today. So even if over 1 year or 2 years, the custom duty were to come down to 2% and import restrictions were to be lifted, what does it mean? And if dollar prices stay the same, even then we will end up losing 20% the value of gold. But I think this again shows that people are simply looking at the past returns and they are not even analyzing the basic information of gold. And that is why even today, even though gold imports have come down, we continue to import smaller amounts of gold. But we think, and if you look at this slide, I mean, we said one thing, it's not here, but there is a quote here, a small quote, that majority is never right. And this was said by one playwright. And majority cannot be rich. Is there any country in the world where majority is rich? Majority is never rich. So similarly, I find that majority can never invest right. So you must have the courage, have the understanding to not do what the majority is doing, because everyone can't make money in investing, because the total returns are same. You make lot of returns only when someone else makes lesser returns. So I think you must, if it comes to equities, please do focus on PE multiples, and low PE multiple investing has always worked, and I think it will continue to work. Presently the PE multiples are significantly below long-term averages. They are trading at 14 times. Economic outlook in India is improving, and I think next year we should see better economic growth, lower interest rates, lower inflation, current account, fiscal is also in control. So I think, and today's record redemptions again tell you that the majority seldom gets it right, so majority is again getting it wrong. And therefore once again I would end this by saying that low PE investing works. So sorry Prem for having disappointed you and giving the same message. Thank you.
Hey, Prashant, that was very insightful. That was really good. Friends, one of the things that we like to do at all Capital Mutual events is to insist that our speakers honor the audience by preparing original text. Where no speaker at any Coffee Mutual Forum is allowed to recycle old presentations. I'm happy that Prashant has gone back and put his time-tested ideas but presented it in a refreshing manner. Thank you so much, Prashant. Can I invite Mr. Jain with ones to come and honor Prashant? Yeah. Okay, we've heard views on the equity markets. It's time to correct the imbalance. Let's have a perspective on the debt markets.